We still have a lot of data coming out this week. We're going to find out tomorrow if the U.S. economy is slowing. And then on Friday, we're going to get the Fed's key PCE. And we closed today at a level we haven't seen in a couple of weeks. It's getting a little nervous out there in the markets, but we're going to break this all down on today's trade-off. Well, hey traders, my name is Blake Morrow and I'm with Forex Analytics. And as you notice, Chris Weston, who's normally here, he's not here today. He's out on holiday. I think he's enjoying the countryside in Australia, but he'll be with us. He'll be back with us. Don't worry. But today we brought in Quasar from Pepperstone. He's going to be here joining us on the trade-off. Let's go ahead and bring him in and let's talk about what's happening this week because we got a lot of key data points we're still coming into. Quasar, good to see you, my friend.
Good to see you as well, Blake. Happy to be back here in the what I like to call the big stage. Yeah, as you mentioned, Chris is out enjoying some vacationing, but happy to be here filling and, happy to be here talking about the dynamics that are taking place in the markets. Has it been getting interesting. So yeah, there's plenty of things that we have to discuss in today's trade-off.
We've been in a tight trading range like the last couple of weeks, but today we closed a little bit weak, and I think we need to talk and dig deep into some of these topics. So let's go ahead and jump into it and let's get the market pulse. Well, Quasar, the first thing that we need to jump into is we need to talk about the PCE. Now, in your opinion, why is the PCE so important to what we're doing?
I feel like we are getting back at the beginning of May, the first, couple of weeks got to see a little bit of easing based on how the, economic trends, CPI, a little bit on the labor market front started to kind of jumping a little bit lower than the expectation. I feel like the second half of May has brought a little bit of uncertainty when it comes to actually data being printed on top of expectations. And this naturally has brought the new one, the key event ahead, which is this PCE, the preferred measure of inflation from the Federal Reserve. Now, the big thematic behind this is that we are expecting to see no progress. That's why I think it's key. I feel like the markets have, it got to be a little bit comfortable after, May's FOMC with Powell being a bit condescending when it comes to the inflation. Yeah, not making progress, easing a little bit of that situation. I feel like now we're getting back to, oh, wow, well, we might be actually not out of the woods when it comes to inflation. That's the key thing that I think, why I think inflation and especially the PCE is very relevant this week.
Yeah, and this is, the Fed's primary component in the way they read inflation. And we have PCE, we're going to get personal income, personal spending. Now, the month-over-month core data, what we're looking for is 0.3%, and it's 0.3% last month as well. So that data, we've gotten a lot of, between the CPI and the PPI, there's not going to be a lot of variation, we don't think. But you made a great point. Data remains hot and it's very sticky, and it's in the U.S. and expectations have come down for a potential cut, and it almost seems like higher for longer is going to be here to stay for a while. Yes. And that actually, I know this data is coming out on Friday, and it's going to be a mover potentially, especially if there's any unexpected beat or miss in that data. And I think people are kind of bracing for a potential, inline, maybe even slightly hot on some of the spending and income. But that's why I really wanted to talk about yields. If you look at yields, the 10-year yield is rallying today. Now, we could argue that over the last couple of days have been some poorer auctions, on the 7-year, maybe the 5 and the 2-year from earlier this week. But the fact of the matter is yields are high, not only in the U.S., you have to take a look around. If you look at Japanese JGBs, they are ripping, yields are ripping. And so I guess the question that I wanted to ask is, what's the market telling us? And in my view, it's telling us that the data between growth, inflation, it remains really hot and really sticky. But what's this rise in yields telling you, and how are you seeing it?
I think you couldn't have said it better, Blake. In all honesty, yeah, the auction side of things is being part of it, but at the end of the day, there's the other side of things, which is the economic print still demonstrating an economy that, it might not be cooperating how we need it to cooperate when it comes to, the data and how that translates into the inflation front. I mean, let's not go too long ago. We have seen, on the in the British side of things, like inflation, yes, falling, but not as expected. We are expected to see in the European side of things actually it getting higher than what it used to be before on the last couple of months. So I think overall that's kind of like what yields are telling us, that yes, on some side of things, the auctions part it's playing, but there's also the economic side of things, and we are adjusting to this reality that higher for longer might be what it's going to be.
Yeah, and just yesterday. Well, I say yesterday for us, maybe a day. It depends where you're at watching this. Australian CPI came in hotter than expected. Australian 10-year yields are rallying too. I mean, this is a global phenomenon, and and that brings in our next topic, the sell in May. Sell in May has not really worked. I mean, that has been something that hasn't worked in recent years. But maybe we could say sell at the end of May, because you said it. And I'm going to agree with you. We're not getting the economic data that the market really wants. The market wants to see us cool on inflation. They want to see us, the maybe growth start to be snubbed a little bit and slow down. But we're not getting that, and yields are respecting it. And now it seems like stocks are maybe taking note of this. So what do you have to say about the sell in May, sell in end of May concept? What are your thoughts here?
I completely agree with you. When you get to see it from a historical standpoint, it might not be the best thing to do, because at the end of the day, you're just leaving returns on the table that you could have taken. When you get to see the metrics from like the last 3 decades, it still yields positive returns during this period of April to around October. Now, this might be the occasion, given how things are shaping up, with sell in May and walk away works this time. Just basically how the dynamic when it comes to actually higher for longer is going to be taking place. Maybe this is the occasion, on a probable more conventional way. Maybe we wouldn't advocate for it, but maybe this time works. That's something to just have into consideration.
Yeah, I mean, we did have German CPI that just came out earlier this morning in our markets. And it would have been yesterday for a lot of people that are watching this now. But the fact of the matter is, inflation seems really, really sticky, and I think markets are starting to take notice of it now. And it might be sell in May, go away, go on vacation, and we'll see what happens. We'll see what happens in the fall. Now, I want to talk about the last topic. I want to talk about the U.S. dollar and where you're seeing it's going. Now, I've noticed that the dollar is right in the middle of a trading range. And I know we're going to talk about the technicals in a little bit, but what's going to break the dollar one direction or the other? Because you would think with the stickier, hotter and hotter data that we've seen in the US, you would think that the dollar would have really responded. The flip side is, everybody's pricing in the ECB to potentially be the first big G7 central bank to really cut. And the euro's actually held up relatively well. What's that saying about the U.S. and the underlying message the market's giving us right now? How are you reading things right now with the U.S. dollar, Quasar?
Yes, no, I love it. That whole part of we are in the middle of a range, 100%. That's what it's happening when you get to see what we have been trading in over the last several weeks. We have been just consolidating, and at some point we're gonna get to have that break. Is it gonna be to the upside? Is it gonna be to the downside? I'm sorry. I don't think we have the clear answer to it yet. Now, what my thesis is in this front is, if we get to, from on one side, if inflation gets does not cooperate at all, and that means that we, as Kashkari even said, additional rate hikes are still on the table, that could be something that pushes and breaks on a positive side for the dollar. On the contrary, if actually we start seeing a bit of cooperation in the inflation side of things, and that allows other central banks to get ahead of the Federal Reserve, given that they are with better inflationary measures right now, I feel like that could contribute to maybe seeing better economic dynamics in these other parts. And just by how this the theory of the smile plays, if that allows for better growth in other areas, that could potentially start seeing, the U.S. is maybe not putting on better prints, And that's where we start to see a little bit of weakness weakness on the US side, and that's what breaks to the downside. We are still yet to see.
Quasar, it's one of the things that keeps it just kind of sits in the back of my mind, and I know it's coming front and center. We have an election coming up here in the U.S. that could have a dramatic effect, especially if President Trump retains his leadership in the race. People might start getting the hint that they need to start selling dollars. That might be policy that he's looking to instill. If he takes back the presidency. Flip side is we're running a huge deficit too, and so I think people are getting a little nervous owning dollars here. But we're going to see. I think you pointed out technicals, I think, are the play. We are in a range. And matter of fact, what I think we should do, Quasar, is we should run into the trade setups and let's find out exactly technically what's setting up next. Well, speak of the devil, it's the dollar. Why don't you kick us off here with the dollar, Quasar?
100%, yeah. What better way to describe what's been happening than this beautiful chart that we have here on screen? Just what I was mentioning, we are literally right in the middle of this triangle, symmetrical triangle that has been taking place over basically, midst of last year. And in between, we are in this support level that is provided by the uptrend line coming from the lows at the end of last year. As we mentioned, there's still a potential for there being a break to the upside. We still have to wait. I personally don't like to trade in between triangles. I don't know how you feel about that, Blake. But here it is reacting positively. And one of the things that when we take into consideration the previous structure, it's a positive one, and that what tells us to some degree from a conventional trading technical setup is that the higher or the upside has a more likely case scenario that's what's going to take place. Now, at the end of the day, we have to wait for this one. But yeah, that's one setup that I really like, Blake.
Well, it definitely is a consolidation. I'm going to stay in the same theme as you, and I'm going to take us over to the dollar Canadian. Now, you just asked if I like to trade inside of these triangles. This is a perfect apex of a triangle that we're trading in, and I happen to be long the U.S. dollar Canadian. And I would have to say that I didn't place myself or price myself too well in this trade, but I did end up getting out with a gain out of the dollar Canadian out of my longs actually today, playing it off of that support. But what you're going to notice is we got a really key support level that comes in around 136. Now it's probably about 136.10 on that rising trend line. We also have a descending trend line of the triangle. It comes in right around the 137.30, and it's dropping every day. So therefore, if you want to play the dollar Canadian to the short side, you might do that right around current levels. But it is a setup, and here's the thing. I prefer playing the Canadian dollar on the short side, meaning I'd rather play the dollar Canadian long, but that doesn't mean that's the way it's going to break out. I think it's eventually going to break out to the upside, but I could actually start really making a case for a weaker dollar. So I think this is the setup. I think we're setting up in a triangle, getting ready to break out of this pair specifically.
All right, Blake, the chart that I wanted to share with you, the other one that I wanted to share with you is the one with the Japanese yen. Definitely one of the main thematics that we have been observing when it comes to the Japanese with the yen is weakness, right? We got to see a bit of the intervention side of things from entities, the governmental entities in Japan trying to protect the Japanese yen. But at the end of the day, it doesn't matter how many bandits you can put into this situation. Whenever the fundamentals are not in favor of your currency, that's still going to bring into the table weakness. And that's what we are seeing right now. Unfortunately, when we take into consideration, because one of the things that we have been hearing is, okay, maybe this weakness of the yen may help in the sense or may have an impact on the inflationary front. And that could prompt the Bank of Japan to get a little bit more to react sooner when it comes to high rate higher interest rates or increasing rates. Nonetheless, that's something that we haven't seen on the metrics on the inflationary front. Yes, this week we got to see on the business service side of things, inflation a little bit hotter. But nonetheless, when you get to see other metrics, that's not being the case. So once again, we're coming up into territory that it's to some degree dangerous. I think it's one for you guys to be careful of, be aware. It doesn't necessarily mean that we have to wait until 160 for there being an intervention. For you guys to have a bit of cautious if you're being exposed to the Japanese yen.
Couple things I'm just going to mention regarding that. Just watch this big breakout that you're seeing in the 10-year JGBs, and then also some of my colleagues have been mentioning that the July meeting is really going to matter for the BOJ. So, a couple things regarding the yen, but thanks for bringing that up. We are getting close to that intervention level that people are watching. All right, the last setup I'm going to talk about crude oil, and this is a bit of a rude trade. We call it rude crude, but what you're going to see is it challenged the underside of its trend line. Just today, we got above the 200 DMA. We got above $80. We closed above $80 yesterday. We rallied to about 80.50, and then we failed epically. Now, I've been trying to understand why or what's going to break crude out one direction or the other. I'm obviously just following price, but the fact of the matter is, if we start trading below like $76, $75, that's going to tell me that probably a couple of things, that we're nearing a recession globally, because that means demand is probably tapering off. Yes, you could build some arguments about where supply and demand is as well. But the fact of the matter is, crude has not been able to rally. It hasn't been able to stage a rally. And so this setup right here, as long as we trade below $81, it looks like we're going to trade back into the mid 70s. So be careful with any longs. I think this is a good setup. As long as you're below 81, we might come back down into that range. And again, it's just a failure under the underside of that trend line, 200 DMA, and then also, back into the range. So with that being said, we're going to jump in, Quasar, to our plays of the day. So stick around.
All right, Blake, the one that I'm going to take as my play for this participation in the trade-off is going to be gold. I personally like gold from a bigger picture, mainly because of a bunch of different facts. On one side, if we get to see rate cuts, hey, that's more than welcome when it comes to, gold. If we don't, and actually we get to keep interest rates at the current levels or even higher, that could potentially lead to something that eventually ends up breaking something from an economic standpoint and create risk aversion. I think that's as well positive for gold. On the other side, all the tensions, global tensions that we have got to see, they're still active. When we talk about Eastern European, the situation happening there, it's still active. When we talk about the Middle East, it's still active. Now, there's another factor I think it's key when we get to talk about gold, which is physical demand as reserves. I think there's a lot of mistrust when we get to talk about the current financial system. There's global participants that are hesitant when it comes to putting their capital, their reserves for, either like US-backed securities or anything related with the West. So I think they're actively demanding actually as a reserve gold. So putting all those factors together, I love gold. Hence, I love it from a big perspective. Now, when we get to see the charts, it has broken. It's showing a positive structure in the bigger picture. I think it's from what it's happening there, I think it's going to continue to 2,700. Now, I think on the short term, we're still waiting for a bit of a correction. I'm going to be waiting for better levels to incorporate myself into this long perspective. I'm hoping for a correction to the 23 Fibonacci retracement around 2,000 or 2,300 with the potential of a higher drop to 2,200. Of course, I would like to divide this exposure in two and hoping for better risk reward ratios on each one of these trades. That's how I like to play gold. And yeah, from a big picture, I really like gold.
All right. Well, thanks for your view on gold, Quasar. I know we all appreciate it. And my play of the day is going to be the semiconductor index. Now, you guys might remember from early April this year, I said, we hit the 161% extension. We came really close, and we actually fell. We had a nice head and shoulder pattern. You guys might have remembered it very early April. Well, we just surged and hit a brand new high, and we actually finally traded the 161% extension. Now, that's 161% extension of the 2022 January to October range. Now, we traded to new highs, and whenever you do that and you actually hit the technical level, I always say we had some unfinished business. We did it. Relative strength diverged. And if you remember the title from early April, I said, take your socks off, or it's time to take your socks off. Well, now, maybe we're just going to put our socks on, since I didn't want to duplicate the title again. But 161% extension, brief new highs. We are failing. It's also via Zero Hedge today put out a tweet that is the highest holdings of most funds right now is the semiconductor index. And so when you're seeing things like that, divergent relative strength, big reversal off 161% extension, possibly false breakout, I think it's time to take your socks off or put your socks back on. You know what I'm talking about. It's the semiconductor index. So guys, gals, Quasar, I want to say, hey, man, thanks for stepping in today for the big man Westy. We're going to hope to have him back next week. I know he's a man traveling the world, so we hope to have him back soon. But it really was nice having you here in the studio with us.
Thank you, Blake. It was a pleasure to be present here in you guys' trade-off.
All right, well, guys and gals, I want to make sure I remind you to subscribe to the channel down below. Jump down in the comments if there's something that you wanted to say about any of our setups or maybe our plays of the day. Jump down below and let us know. And also click that subscribe button, click the like button, and we'll see you next week on The Trade-Off.